So the S&P 500 rallied another 18 points today, and now up over about 200 points off of that Christmas Eve low point that we had near around the holidays. Almost a 10% move off of the lows. So quite the snapback rally here, approaching some levels of resistance. So we're going to break that down today. What our near-term expectations are as we head into that resistance, and what we expect things to do then. And where markets may go in the next month or two, and when and if any kind of bullish trend may develop and how it's going to develop. So we talk about all that today. We take a look at what's driving the price action, which sectors are outperforming and why, and how we can trade it. So let's go ahead and get started. Today is Monday, January the 7th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500, off the market forecast, on the S&P 500. You can see another update today, closing up above yesterday's high point. Small, only an 18-point move, but still a good close. The near-term line up in the reversal zone again, coming from the lower half of the chart. So coming from a bullish near-term low point, a low between 20 and 50, but also a higher low point. So bullish near-term low, already up to a bullish near-term high because it's above 80, and it's a higher high. It's a higher near-term high already. So a good sign from a short-term perspective. But again, remember, when the intermediate line's rising, it's bullish, but it's below 50, so it's not very strong. Consider it like a football field, right? It still hasn't crossed the midpoint yet. And when the intermediate line is on this side of the field, the near-term runs are shorter. So they might be bullish, but they're shorter. So consider that. We might run up to this 2600 area and meet up with some resistance after maybe another day or two, and then run out of gas, right? And have a new near-term low. And the question is going to be, where will the next near-term low be in relation to this one, which is the previous one? Will it be higher? Will it be equal? Will it be lower? Will we retest this 2400 area as another low point, which definitely has a decent likelihood of happening. Past precedent suggests that we will come back down into this area. This was an extreme low point according to multiple oscillators, and we usually retest those lows. A lot slower, and this was a lot quick. This was a surge that got us down to this first one, but usually we retest those low points again, and usually it occurs within a couple of months. And so after an initial test of a resistance level, which may be in this case a 30-day moving average or the 50-day moving average, but we retest that. And so yes, we're getting a new near-term high, and we might go up a little bit higher. We got another 50 points until we hit that 50-day moving average. We'll see here in a minute. But will we get down to a lower near-term low? There's a good chance. I won't say most likely, but there's a good chance we'll get to a lower near-term low. That won't necessarily mean, now it will seem like the world's going to end. It will seem like the bears are back in full force. If we get back down below, what would that be, 2445-ish? People will be saying, this is it. This is the bear market to end all bear markets, and the financial media will start promoting more market and turmoil. But the reality is, it will just be another retest of a major significant low point, which is very, very typical of this type of price action when you're below the 200-day moving average. It doesn't necessarily mean that we're going to fall off a cliff. It just means that we are looking for what would potentially be a divergent low point that ultimately will propel us back up at least to the 200-day moving average, if not up through it. And you can see, again, all the major indicators all have similar patterns in their market forecast. Rising intermediate lines. You can see the NASDAQ had a really good move, getting up to that 30-day moving average, and the Russell as well. So very strong short-term sentiment for both those indexes, with a weak bullish posture. The Russell's still got that market sentiment below 20, so it's still, and there's a lot of growth potential as that market sentiment line gets eventually towards 50 and potentially through it. Now remember, as it sits below it, you get a lot of choppiness. Just like on the intermediate line, you get shorter near-term runs when the intermediate line is below 50. When the orange line is below 50, you get shorter intermediate runs until you get up above 50 and you get the longer, more extended intermediate rallies. Alright, before we look at some other charts, a reminder to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your video. Click that red subscribe button that pops out. Also click the thumbs up icon down below the video. That tells us that you got something out of the video today, and more importantly, that one click with the thumbs up tells us keep doing the video. You want us to do the video again tomorrow, the day after that, and to keep on doing that. Also, comment down below on anything that stood out to you. What did you get out of today's video? Was there something that in particular, was any questions or comments you have? Post those down below as well. Join our Market Scholars Market Outlook email, our daily email list. There's a link popping out in the top right corner of your screen up there. Click on that link to subscribe. Follow me on Twitter for more content like this throughout the day and between the videos from day to day. And then finally, join our Market Outlook community that we created on Facebook. While you're watching the video here on our blog, scroll down below the video and make these 3 clicks. Number 1, click on this heart right here. It opens up a new window. You can like today's Market Outlook tweet there. Again, clicking on this button tells us to do the video again tomorrow. If you don't want us to do the video again tomorrow, just don't even worry about that. Also click this image. This will take you to your Facebook account where you can like today's Market Outlook post there. And then thirdly, you can click on this like button here on our blog. Remember, our calendar here of classes is over to the right. You can go to the events to see the full calendar for the rest of the month. And then of course you can also discuss tonight's video with other market scholars in the Market Outlook forum on our website. To do that, if you're not subscribed, you can do that for free right here by clicking on this image under Join Market Scholars. Alright, back to the charts. You can see here's that 50-day moving average I was talking about, right about 2600. So we still got some room. Technically it's right there, at 26. What would it be? 2610-ish, a little bit below that, a little bit below 2600. But that's that orange line. That's the 50-day or 10-week exponential moving average. So not quite the 50-day simple moving average, which is typical, but similar. You can see the candles are getting smaller as we approach that. If you look at the Hakinyashi candles, we're getting last week we got the upper shadow, which again, when you get the reversal, you get the smaller bodies and the upper shadow. So we got that last week, the smaller, much smaller body, and finally an upper shadow, similar to what you see here. We didn't get the reversal there. We obviously came down, but now, as you can see, we are getting the reversal, more of a bullish body, the open of this candle down at 2507. So we've got some room to the downside that we can work with before we get a lower shadow. I wouldn't be surprised if we don't. See, when you're getting these kind of major lows, you tend to get some ups and downs. See, it took a few weeks here before we finally got that bullish trend started here in May earlier last year, in the middle of last year. So if we are going to retest these lows, you're going to get some more candles on a Hakinyashi basis, kind of like this. Let's go back to a regular candle here. Oops. It's a candle trend. There we go. So, again, a little bit more room. They'll be essentially be at the top of this candle, which will also be, again, like I said, where that 50-day moving average is, where you'll find some resistance there. If you look at the 3 green arrow chart, again, you don't have the 3rd green arrow yet until you get above that moving average. It's usually the last one to come, and you know what? That can act as a resistance level. So we might not even get it before we hit some resistance and roll over more to the downside. It's kind of hard to get the green arrow and stick it until that moving average flattens out enough to turn up. You can see here it was red and yellow, red and yellow, red and yellow before it finally got above. But by the time it broke up above, it had flattened out enough to turn higher. We're not going to turn higher on this line anytime soon. At best, we're going to get a yellow line, but not a green, which means we're above a rising moving average. And that's when that intermediate trend solidifies and really takes hold. You look at the 3 green arrows, You can see, we haven't tested the 30-day. We've tested the 17. We've got above the 17 today, but now we've got to test that 30-day, and usually that will coincide with the MACD getting towards zero and then kind of hiccuping there and then coming back down there. So we're getting closer to get that up towards zero. It doesn't usually go from extreme low to extreme high. It usually goes from extreme low towards the midpoint, a little bit above or a little bit below, but anywhere around the midpoint, and then you get more of a downturn, a divergent low point, a much higher low point than what you'll see on the chart. And then these lines will converge closer to each other. It'll be easier to not only retest the 30, test the 30 and get above it, and then get the green arrow and the green line, get the rising moving average, but also get the 8 and the 17 day to cross up above 2, which will be kind of like our last stage of reversal. All right, looking at the intraday chart, you can see the range really starting to drop off. So, we're going to move down. The high of the 4-week range is going to move down a little bit more for the next few days. It's going to be right there, and it's going to gradually really move down after that, especially into next week, down to this high, which means the 4-week midpoint is also going to move down. So we're above the 4-week midpoint now, and it's going to move down a little bit tomorrow, probably around this 250, a little bit below 250 area, which means it'll be more up above it, and then it will really move down as the high for the 4-week range moves to that point. And even then, we'll be really close to the high point at that point. And even then, it will still be a pretty wide range, close to 10% range if we get to that point. So we still got a very, very wide 4-week range here. We're not out of the woods in that. When you got the wide range, it leads to big volatility because of how big the moves can be within the 4-week range. But a higher high, higher low, closing above yesterday's high, closing above last week's high so far. So a bullish close from that perspective. If you take a look at the volume and the trading range, the trading range is below average. Not very much of a gap. 252.39. Today's low 251.69. So no gap there. And then the volume at 103 million. So putting this in context of the averages, 100 and some odd million is down, 103 million down here, well below the average. 4-point range we had today, also well below the average, which will start bringing this relative ATR down. So falling levels of these, you don't typically get that bullish trend to hold until they've been coming down for a while. So you'll still get some choppiness as they're coming down from their extreme highs. You'll still get a new low point. So that just because they're coming down doesn't mean we won't get a new low point. We'll still get a new low point, most likely somewhere probably around this 240 area. And then the bullish trend takes hold after they've been going down for a while. And again, it takes hold as well when volatility breaks this 90% level. So we're going to come down, most likely find some support in this 90 to 95% area, around 20% or 20 on the VIX itself, and make a run probably towards 25 again before volatility moderates and we're able to get more of a breakdown below this neutral area. Once you get below 90, that's when the bullish trend will really take hold, as you saw in previous instances over here in May. Again, finally got below zero. We still had a couple jumps up to 1, but for the most part below 90 was able to really that bullish trend was able to really take hold by then. So to summarize, the posture is bullish. It's weekly bullish, which means short near-term runs. The long-term trends still not even bullish yet for most of these major indexes, which means the intermediate rallies may be short. We might get those hiccups around the midpoint of the chart. So there's still going to be some volatility here in the short term, even if we might rally maybe another day or two towards the 50-day moving average, towards the 30-day moving average, towards other resistance levels, and then get some more choppiness down to what could be a new low point. It won't be straight up, it won't be straight back down either. There's going to be some ups and downs with volatility at up above 20 over the next month or so. There's going to be some ups and downs. There's going to be days you think the market is, we're in Great Recession number 2. There's going to be days you think we're back to being bullish again, and that's back up the truck. And the reality is that's not going to be, neither one of those is going to be the case. First, the former is not going to be the case until we test that 200-day moving average and fail there. And then the latter, the bullish market's not going to take place until all these signs we've been talking about, which haven't occurred yet. And so in the meantime, we ride through the volatility and make sure we're balanced in our trading accounts with bullish and bearish trades, and we're able to take advantage of both the up and the down moves. So what do you think about that? Do you agree with that outlook? Do you disagree? Click the poll popping out in the top right corner of your screen, then click either agree or disagree. If you click disagree, scroll to the bottom. Let me know there what you're seeing that would suggest otherwise. Maybe you are more bullish than I am right now. Maybe you are a lot more bearish, that you may think that we are in this bear market. Either way, let us know down in the comment section below with what you're seeing. Not just obviously what you want to see, but what you are seeing that would suggest that. All right, now let's turn our attention to what's driving price action today. And you can see one of the biggest gainers early on was crude oil, up almost 3% at the open early this morning. It did pull back, only finished up 1%. Small cap stocks also were up over 2% at one point in time today before pulling back with a 1.75% gain. But way outgaining large caps. You can see emerging markets here in brown, and developed markets lagging behind U.S. stocks. With the U.S. dollar down, that's not typical. With the U.S. dollar down, usually that's a bullish sign for not just commodities like crude oil and gold. Gold here in red, so gold had a bullish day today, but also typically is good for international stocks. They tend to outpace U.S. and that wasn't necessarily the case today. As you can see, the U.S. stock market up 0.75%. China up 0.25%, Japan up 0.25%, Germany up was flat, UK flat here. Here we go on this day, 1.7 there. You can see France up 0.25%, India down 1.25%, Italy doing well, Brazil down a little bit, 1%, Canada up 1%. Russia flat, and Korea up 0.25%, all lagging behind the U.S. market, except for Canada and Italy. Everybody else, but you can see very common patterns here as we all are approaching resistance levels. The only moving average that's green right now is India, as we're above a rising moving average, and then Brazil, as we are easily above a rising moving average. Everything else up approaching, and right now you have the US, you have Japan, you have Germany, UK, France, all the major economies here all approaching, Russia as well, Canada approaching their moving averages. So most of the time when you're this far below and you're approaching up to them, you tend to hit it first, and then retest or maybe double bottom before, and let that gap shrink some before you are able to turn it around and turn it green, like you see here with Brazil. This is kind of rare, but remember, this is actually, if you look at Brazil, if we zoom out on it, it had a little bit more weakness than what you're seeing right now. So you had this weakness here, then you got up above it, and it wasn't able to really hold, and you retested and double bottom before things finally got it turned around. So this is actually a higher low point, not necessarily a deep low like we're seeing on all the other major. This is a lot earlier. What we're seeing now on all the other major indexes is this move here, in the US and others. This occurred for Brazil. What we're seeing now in most of these other countries actually has already occurred for Brazil, and Brazil is coming sharply off of its lows. It was down at one point 25% here on this 1 year chart, and now is only down 3%. So it's had quite the gains over the past few months, whereas the rest of the world has been pretty darn bearish. Take a look at what occurred on the calendar today. You did have the ISM services. The manufacturing got a lot of press last week, with coming in with a pretty weak number. The services came down too, but still a pretty high number, relatively speaking, higher than what we saw all in 2015 and 16. But still much lower than where it was a few months ago when we were at some really strong high numbers. Factory orders also pulling back on a year-over-year basis, which is more important. The year-over-year numbers. You also get the month-over-month changes, down 2% prior and down up 4%, but it's that year-over-year number that matters the most. And you can see still strong growth, pulling back, but still some strong growth there. So you look at the economic surprise index is still negative, and it's improved here in the U.S. over what you see globally. But it's the interest rates that matters. How do these impact interest rate hike expectations? And interestingly enough, rate hike odds for 2019 went up. Still, again, only 11% for the whole year just to get one rate hike. So, you don't have high odds of getting a rate hike in 2019. But what you did see, interestingly, is it didn't come from lower rate cut odds. They're still the same as they were, a little bit of a drop, but it came from here. So there's higher odds that we'll get a move. There's about a 25% chance or more, a little less than 30, that we'll get a rate hike or a rate cut, something. That we won't be at the same level now by the end of the year. And again, that's not very high either, but you get the idea that this economic data is going to influence either side of this, this rate hike with the current levels being here. And again, this is the December meeting. If you look at the historical chart for the December meeting here, you can see how volatile it is. So the purple line is the current odds. See that big drop off, the drop off occurring for the odds of a rate cut jumping up, and they've fallen back down. The rate hike odds, which were pretty high, relatively speaking, earlier, especially when you add on the second rate hike odds, you add those two together, they're pretty high odds of getting at least one. The second rate hike has gone down to 0. And the one rate hike in red did go down to 0. It's popped back up a smidgen here, but you can see how low it is relative to other potential rate moves. So you can see a little bit of a bounce in bond yields after such a big decline. We've had multiple weeks really since that October the 3rd, which is right here, the week of October the 3rd. That's when yields peaked, and we finished that week at 3.22%. We've come all the way down to 2.68%, but we're hitting some support at these old highs on the yields. Crude oil, remember, made that bigger move. You can kind of see it's got a lot of move to go, and very similar to the S&P or the Dow. It's down below, sharply down below the 200-day moving average, which means it's going to test that 50-day first, most likely, as it rallies higher. Before trying to figure out a new bottom similar to over here, and then making a run towards the 200-day moving average. From a sector rotation standpoint, you can see, again, here's the new updated rankings according to Brandon's sector selector tool that he updates on the Market Scholars blog, so make sure you check that out. And remember, you get the full version of it. Subscribers get the full version of it. Anybody can check out the current rankings, which I've got them here saved on this grid, and the biggest gainers today have been some of the biggest losers. So technology there, almost 1%, communication or discretionary 2.25%, industrial is doing well, energy up 1.5%, real estate performing better. Some of these others, utilities was down a little bit today, staples were down a little bit today. Financials were up small, lagging behind the market. Materials, healthcare also lagging the market. So you're, when you're oversold like this, the losers gain the most, and the winners, the previous winners, go up the least, or maybe even go down a little bit. They're all share very similar patterns to the broad market as a whole, and some sectors are closer to the moving average and might be above it, like we see with discretionary. Versus others that are further below, like utilities right now. Discretionary or communication services also above its moving average, but then you see like utilities and real estate, both, and staples for that matter, both well below their 30-day moving average. So they had held up pretty well and kind of fell off a little bit here in the holidays and haven't been recovering as much as some of these other areas, which is what you'd expect when you're coming off of deep lows. These other more cyclical areas will bounce up the most until we get more entrenched in the bullish trend and more overbought. Then these areas will start to gather some relative strength, utilities and staples and healthcare and real estate. All right, one of these cyclical stocks that had a little bit of a breakout today is AMD and these chips in the chip sector. You can see AMD breaking up above its moving average, getting up in the upper half of its Bollinger Band width, breaking through an important resistance, volume resistance level there. If you take a look at its market forecast chart, its posture also weekly bullish, but you can see its short-term sentiment stronger and getting up above a moving average that's flat, and so it's going to be easier for it to turn green, for that moving average to turn up and turn green, than it was, say, back here where it was falling sharply, and a nice move up above it turned to green for like one day, but was mostly just yellow then. So a better chance of turning green right now. Looking at the 3 green arrow chart for AMD, you see you got the 3 green arrows today. Not quite the spike in volume. It's not looking for a big bullish move here, but three green arrows nonetheless. Look at its long-term view, and it's been a really beaten up area. But you can see after dropping sharply below its 200-day moving average, we've gotten right back up above it and above the 50-day moving average here. So a little bit more of a bullish setup here, and a little bit of a triangle forming than what you see, say, on the broad market as a whole. So then finally, let's look at that DMI chart, and we'll look at AMD and pull up the other. Here we go. The DMI indicators. Again, a bullish DMI oscillator, which means we're getting a crossover, positive over negative. That crossover occurring below 25, and then you can see the stochastic stream also turning up. So bullish patterns nonetheless. A little bit of a bullish breakout. So when you look at the charts and you say, okay, well, how can we trade this? Here, let's reset that. This is based off a class on over the weekend. We're looking at some theoretical values. Let's take a look at that. Well, we can look at the 2018 and the $20 selling the 20, buying the 18, about 80 cent credit. You need to get at least 47, so you're getting a pretty decent credit there. Might go to 1917. We can still get a pretty decent credit on that as well. Don't think we can on 1816. Yeah, we can. Look on the 1816 level. We need to get at least 47 cents on a $2 wide. So when we analyze that trade, so it slices a break even. You can see the odds are 2/3, pretty decent chance. Set that slice to the break even, and that puts us below these lows here for us to have to fall back down below to be able to just break even at expiration. Of course, we're trying to make $53, so for us to lose $53 on any day, we'd have to get down below the 17 area. So that would be right, in this area. So we'd pretty much have to get back below these lows right here. You had that one downward move, which is the near-term low on the S&P. We'd have to get below that on the stock for us to reach a loss that'd be equivalent to the gain that we're trying to make on that short vertical spread. And again, we're doing this short vertical because we're not getting strong volume. We're not looking for a new trend to develop yet. The market's not strongly bullish yet, but cyclicals are doing well. We are still anticipating a little bit more bullish run here before we meet up with some resistance. And this stock has got more of a bullish pattern than the broad market as a whole anyways. So without being aggressively bullish, we can make a less bullish trade. Bullish directional nonetheless, but still a smaller directional trade, and try to get something out of it while trying to maintain some balance between bullish and bearish trades in an active trading portfolio. All right, now I want to hear from you. So let us know what you think. There's that link popping out up there that will take you to our forums where you can participate. Remember, you have to subscribe to the site to participate there, but you can do that for free. Any questions or comments you have for me about tonight's video, any questions or comments you have that I didn't cover in tonight's video, you can always post those there and be able to interact with other market scholars who can also answer your questions, and you can be able to answer theirs with anything that you may be seeing. So as always, thank you very much for watching tonight. I appreciate your time. Have a great rest of your evening, everybody. Remember to subscribe to our YouTube channel, click the thumbs up icon below, and comment on the video. Follow me on Twitter for more content like this. Join our Market Outlook community on Facebook as well as on our website, marketscholars.com. Again, we'll see you all next time.